So how will whole life insurance work if things are not going so well? Particularly if there's a recession, stock market crash, what about inflation or rising interest rates? What will happen to whole life insurance policies? A lot of people ask this question who presently have whole life insurance and people who are considering whole life insurance policies, of course, designed for maximum cash value. So we are going to discuss just that in this video. We will start with point number one, which is what will whole life insurance look like as a result of inflation and rising interest rates. We are going to look at a lot of history in this video, so we'll have some fun. What is typically impacted by inflation, mainly interest rates more than anything else, are dividend rates, specifically dividend interest rates with life insurance companies. If we look at some dividend history right here, this is with Guardian Life Insurance Company. We've got 1959 all the way through 2022. We're going to come back to this and reference it a couple times throughout this video. But dividend rates, historically speaking, do rise when interest rates rise, and they do decline when interest rates decline. For example, if we were to look at a high interest rate period, let's pull that sheet up again, and look at the 1980s, what do you notice here with respect to dividend interest rates? Well, they are at all-time highs on this chart. If we look at post-2008, after the recession here, and interest rates continuously came down, what occurred with dividend interest rates with life insurance companies? They continuously came down. So dividend rates do tend to follow that trend. Now, with that said, it is not an automatic, meaning if the interest rate environment, if interest rates go up or interest rates go down, dividend rates are guaranteed to follow. No, what it has to do with, what impacts dividend interest rates with life insurance companies really has to do with where life insurance companies invest. And really the question is, what assets are available for life insurance companies to acquire? Specifically, what assets that are still AAA rated, because insurance companies are very concerned about their safety ratings. This is why they cannot just dump a ton of money into the stock market. They can't do that. Cream of the crop safety ratings. If you were to look at the Comdex score, which is almost a ranking of all the different safety ratings and financial strength rating carriers out there, and take your four major mutual companies, Mass Mutual, Guardian, New York Life, and Northwestern Mutual, you'll see between a 98 and 100 on that Comdex score, which is cream of the crop when you look at rankings there. So how you obtain or how you attain that high ranking is one, by positioning your money in safe assets, but then second, they also have to remain competitive. I mean, you could just put a bunch of money in cash or under your mattress. That is safe, but it's not going to be competitive, and you'll quickly go out of business because you're not keeping up with inflation there. So where do insurance companies position their money? That's the question. Well, if you were to go back to that high interest rate period, let's look at that again. So what do we notice here? High interest rates. Where did insurance companies invest here? Bonds. They were very, very heavy in bonds. Life was quite easy back then compared to what things look like today. Insurance carriers could just acquire a 20 or 30-year bond. They would typically acquire them in bulk and hang on to the things for a long period of time. So life was easy back then, and you would see a very high percentage of a life insurance carrier's assets invested in bonds. Now, today, where can they position their money? Well, they can go to bonds, but you'll also see, before I progress on here, you'll also see them invest in high-end commercial real estate. They'll acquire other businesses. They'll invest in other companies. Basically, what they're looking for is, where can I go with my money that is still safe and generates a competitive return? Now, if you look at things right now, a question that comes up today, we've received this a number of times is a whole life insurance policy. Steve, your company says it's going to produce somewhere between a 3 to 5% net growth rate, and that's likely what it will produce. So with what you said, Steve, and with what your company states, if I look at inflation right now, and that's at 7%, even faster than that, like a life insurance policy, the growth on cash value does not even keep up with it. What's going to happen with whole life? Should I look at other alternatives? The answer is you should look at everything that makes you comfortable, right? Look at different options. A whole life insurance policy can work. Here's the question. With dividends and with everything going on with inflation right now and even rising interest rates, can dividend rates on whole life insurance policies, if they go up, can they keep up on a short-term basis and also a long-term basis? So what I mean there is if interest rates rise like they did back in the 80s and insurance companies are able to acquire assets that will allow them to participate in the upswing, which will likely occur, can they keep up with rising interest rates? On a short-term basis? No. Hasn't happened in the past, probably will not happen now. How about from a long-term perspective? I would say yes. Now, here's what we want to look at here. If we go back to the 80s, that dividend interest rate peaked where? At about 13.25% when we look at that. Now, at that point in time, if we look at that peak, what could you get a CD for back then? Or a mortgage? At any point in time during the high inflationary period of the 80s. Much higher than 13%. Right? We could see it between 16 and 18% easily. So what happened back then with respect to whole life insurance products is companies were struggling. Specifically, whole life insurance sales were negatively impacted as a result of the high interest rate environment, or interest rates rising very quickly. People were not putting their money into whole life insurance products. Dividends were not competitive enough. So insurance companies, they're good at making money. What they did at that point in time was come up with a new product in the 80s and 90s. In the 80s, they came out with universal life insurance, specifically current assumption universal life insurance. What that means when I say current assumption is that the interest rate assumption that was applied to that universal life insurance product that, let's say, you would buy back then was based on the current interest rate environment. So current assumptions, current interest rate environment, that interest rate is assumed on the universal life insurance policy. That's what's actually applied as far as a crediting rate. So if I bought it back in the 80s, let's assume it was 16%. Very quickly, I said 80s and the 90s. What came out in the early 90s was variable universal life insurance, which could actually allow one to participate in the stock market. So even more potential there. But looking at universal life, I could see an illustration. This is what happened back then, easily, that produced 16%. So on that illustration, let's back up and take a look at a whole life insurance illustration, which is what we look at all the time on this channel. If I've got a dividend interest rate of 6%, that illustration will assume a dividend interest rate of 6% forever. However, as the years pass, things change. So here, if I have a 16% assumption or interest rate on that illustration, guess what? It's going to assume 16% forever. So as time passes on that illustration, things will look beautiful. With a universal life insurance policy, where that is different from whole life insurance is as time passes, you'll see it here in red, COI stands for cost of insurance, that'll gradually increase. However, if I've got a 16% assumption, if I have an 8% assumption, the cash value growth will rapidly outpace the actual increasing costs. So the growth is so far ahead of the actual costs there that someone would look at it and say, that's never going to happen, especially based on a 16% crediting rate assumption. I could cut it in half. I could even bring it all the way down to 5 or 6% on the interest rate assumption, and that cash value growth would still outpace the cost of insurance. So what are the chances, if you're living in the 80s and you're looking at this product, of the costs ever catching up to the cash value growth on that projection? Most people would think that'll never happen. Do you think agents back then may have said, you don't have to worry about the guarantees? Probably. I mean, I don't know anyone who actually said that, so I can't make a claim, but probably, just knowing human nature and such. However, when we look at reality, what actually happened? Well, there were a lot of lapses and lawsuits. In short, what happened? Interest rates eventually came back down. The expenses exceeded the gains when we look at the actual values, not just the projections. So universal life insurance products took a lot of heat back then, and that's why some people are still skeptical of them today when they're primarily focused on the cash value component. Now, with all that said, that storm and that mess back then in the 80s with these new attractive products that became available to the public, to consumers, life insurance companies were trying to generate revenue, it didn't work, right? That's all we need to say. Whole life insurance policies were still available back then. If you purchased a policy back in the 80s, if you started in the 80s or early 90s, if it was with one of the major mutual companies, today, through 2008, I'm talking all the way up until today, that has produced somewhere between a 5 and 6% internal rate of return. Through 2008, with no risk, peace of mind product just continues to grow. And how we can see that is when we look at proof of performance. So we're big on historical performance. I know I talk about this a lot, actual performance, not just illustrations. Here's a study period, just 20 years, 1984 through 2004. This is from a Blease report. It's an independent study of life insurance products, age 55 male. Here's the actual internal rate of return on those products. You've got your big four on the left, Mass Mutual Guardian, New York Life, and Northwestern Mutual. And this is just a 20-year study period. We've got some studies here that go much, much further. In fact, if we look at, where do we go here? Here's a New York Life policy that was actually purchased, where am I? In 2003. So this was after the 90s, obviously, early 2000s. 17 years old, and his 17-year average IRR is 4%. And this was actually in 2020. So this is a couple of years old, this example. As the years have passed, it's done a little bit stronger. If he would have started even earlier, obviously the net internal rate of return would be stronger than this. And this was a policy that was not designed with a very aggressive PUA payment. It had PUAs going toward it, but it was not super aggressive. We have policies on record that have done a little bit stronger than this when they've been designed more optimal, if that makes sense. Let's continue on here. So my point to this is whole life insurance products back then did not seem like a good idea. The reason why is because interest rates were by far outpacing dividend rates at the time. So typically what I like to say here, or what I like to think for myself is, right now if I look at the storm, this old, slow car does not seem like the best vehicle to get in. I don't know if it's going to get me through the storm. Let me get in this jet. So I'm going to get in this jet to try and fly out of the storm. Turns out the wings on that jet are not that secure, and it gets blown off into the distance, and I lose all my money, right? If it's a money jet. Here, I've got this old car that I don't know if it's going to make it, but it just keeps on going the same pace. And eventually, I get through that storm. So is it a good area to position money? Short term, I might look at it and think, oh my goodness, I'm not going to get through the storm. Long term, it's always worked out. Just based on where insurance companies position their money, the net growth rate is going to fall where? Somewhere between 3 to 5% at the end of the day. That's just the reality of it. Could it do better if interest rates shoot up and dividends participate and it holds for a long period of time? Maybe. Then I might say between 3.5% and 5.5% as far as a net internal rate of return. But just to properly set expectations, we never want to state that the policy is going to do better than what it likely will do. That's where buyer's remorse comes into play. If I think I'm going to have a lot of money because I told you you would, and then you have much less. So, inflation and interest rates. Does whole life insurance still make sense based on what's occurring with that right now? In my opinion, yes. And we'll see how long the rising interest rates last. They may come back down after a period of time as well. How about a recession and market crash here? This one's important. So, during recessions and market crashes, what I have always seen here is interest in whole life insurance tends to actually grow. People are looking for fixed assets, where's a safe place I can position money that's liquid. Hey, if it's tax-free, that's great. But typically what's going on here is safe money. Fixed assets become more appealing because people do not want to take on risk. If I can find guarantees on a product, that is even better. Now the 4% guaranteed rate, if you have a whole life insurance policy with the 4% guaranteed rate, you've got that locked in forever. Today, the guaranteed rates are lower, but if you design a policy correctly, you will have a similar outcome to what a product that still has a 4% guaranteed rate has. Guaranteed rates on whole life insurance policies today range between 2 and 3.75%, depending on the company and product that you select. Liquidity is huge as well during a recession and market crash, more so a recession. This way, in the event I need access to any of my cash, I have it. A lot of business owners, a lot of real estate investors actually view recessions as an opportunity, because when there's a contraction and everyone pulls out, all of your competition that is, no one's buying, they're afraid of losing more money. What a lot of people I've seen, they've done this successfully, is they view it as an opportunity because everyone else backs out from a competitive standpoint. Now people can lean in and expand into the marketplace because there's more fear and uncertainty as far as how long will this recession last. It could be a bad move. I don't know if I want to do it. So some people really view it as an opportunity and have done extremely well. The more liquidity I have during this point in time, the better I can do. Just historically speaking, what I've seen when we look at trends and just speaking with people that have done this. Here's the important part with a recession and market crash. Policy design. Life insurance policies do lapse during recessions, right? If people don't have the money to pay premiums that they thought they would have. Policy design is critical. I talk about this so much. Designing a policy properly for minimum expenses, maximum cash value. This does a number of things for you. If you've got a policy designed with a minimum premium, say it's one of your major mutual companies, and you've got a 10% minimum premium, what that means from a commitment standpoint, what you are obligated to pay, whether you're paying the premium or not, I'll explain that in a second, but what you're obligated to pay is the 10% premium. So for example, if you said, hey, I want the ability to pay in $100,000 per year, and my premium is 10%, that means my actual commitment is $10,000. If you have a term rider attached, maybe it's $11,000. But you're committed to a minimum amount. This way it never feels like a burden. And then you've got the ability to throw additional funds into your PUA rider, another $90,000 per year. So if I can't fund the full $100,000, well, now I can commit just to the $10K minimum and then add additional funds up to a total of $100K at discretion. Now, what if I can't pay anything into the policy, but I still want the option to make payments in the future? What you can do, there's a couple things here. One, you can do what is called a premium offset. To translate that into English, that means you're going to allow the dividends and interest, so when I say interest, the guaranteed portion as well, to pay your premium for you. You can have the policy earnings cover the premium. Anything left over is kicked back into cash value and helps continue to grow your policy. So one, you can have the policy pay for itself that way. Two, you can do what is called an APL, which stands for Automatic Premium Loan. That's going to allow the policy to take a loan against itself to cover the premium. That can work quite nicely in some cases. There are some people we work with when their premiums due, they say, I can't pay it right now, but I will be able to pay it in 6 months. Maybe they've got Mass Mutual where we can only adjust the payment one time per year without underwriting. So what they do is have an automatic premium loan exercise to cover their full payment, and then they'll cover it, they'll pay that loan off 6 months later. The only out-of-pocket cost in that situation was the loan interest. In a case like this, however, let's say it's going to be not just 1 year, but maybe 3 or 4 years that I feel I can't make the payment. Well, if I'm going to have the policy take a loan to pay for itself, just the base premiums required, not the PUA payment. So now, if I can have loans taken internally just to cover the base premium, that lower base premium impacts my policy to a lesser negative degree. Not as much is what I meant to say there. So, policy design is particularly important and also very valuable here in a recession, in an environment where people can no longer make the same payments that they thought they could. And a lot of times they've got the funds or the means to as well, but they're using it for other assets. They want to keep more in cash just for that peace of mind, for a peace of mind standpoint, whatever it might be. But good idea to have a low premium there. Policies will lapse, typically more so in a recession, but why they happen is one, if the base premium is too high, that commitment's too high, they're saying, okay, I don't want to have to pay this each year. I don't want to have a policy loan taken to cover the base premium, referring to the automatic premium loan, or they don't see the value, meaning they've been paying money into the policy. They don't see the cash value there. It's taking a long time to generate any value. Like they don't see it. And they're thinking, hey, things are tough right now. I'd much rather salvage my money, at least what I have here. I'm paying a premium. I'm not getting all of it back. I want to see that money there so it actually makes sense. Like I can justify it in my mind to put money here and it helps me in this point of time. Doesn't hurt me. So this is where policy design and really just creating flexibility is so important. So I hope this video was helpful. I always have fun talking about this stuff. If you did enjoy it, please hit the like button, subscribe for more. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.